Why should I care about the rising interest rates? Hello everyone, I'm Tom and this is Tom's Funny Magic. Today we're going to be having a look at the current rising interest rates. Before we talk about the rising interest rates, I'd like to talk about why loans are so helpful. So as you may know, loans are amounts of money that you can borrow from the bank to pay for certain things such as buying a property. Loans were created to allow people to spend more money than they would have otherwise had at that point in time, which means that without them there would be some things that you would nearly never be able to pay for. So for example, first home buyers may be able to buy their home a decade or two before they would have been able to do if they had to save up the total amount. Investors use loans as one of their greatest tools, allowing them to purchase new properties or other investments faster and more reliably than they would have been able to without them. Banks want something in return for lending you money, which is why when you pay them back, they charge you extra money in the form of interest. This interest is a percentage of the total amount left on the loan, which you would then pay back on top of your normal repayments. This percentage used to be around 2.5, but it has recently risen to around 3.8. For example, let's imagine you have a $100,000 loan, you're paying a 3% interest rate, and you're going to pay a repayment for a 30-day month. So first you'd figure out that 3% is $3,000, which is the yearly interest. But to figure out the interest for that 30-day month, you would then multiply it by 30 over 365 to figure out that for that 30-day month, you're paying $246.58 in interest. Interest rates are currently increasing due to the mandate set by the Reserve Bank of Australia. This central bank in Australia controls different things such as interest rates and the buying power that different people would receive. In this case, the RBA is mandating for interest rates to rise because they want to help combat the current higher than optimal inflation rate. The current inflation rate is higher than the optimal range that the RBA had produced, which you can see on screen now. Inflation is based on the Consumer Price Index, which is calculated using a few different things. One of these is the amount of money being spent within the economy, and this is currently higher than usual because of a few different factors. The two main external factors affecting the current inflation is the Russia-Ukraine conflict and the lockdowns and supply chain issues in China. Russia is a big supplier of coal and gas, and many countries rely on Russia for these resources so that they can create electricity. So due to this big supply being taken out of the industry, it means that the demand for these resources is being funneled towards less total suppliers. And this allows these suppliers to raise their prices because they know that the countries have less options to choose from. This has in turn increased the amount of money that people have to spend on electricity, inserting more money into the economy. The second main factor is the supply chain issues revolving around the China lockdowns. This has reduced the amount of supply of different items, with technology being a big proportion of this. This high ratio between the demand for these products and the low supply means that the prices of these products are also rising, which means that people have to spend more. To summarize this, the RBA is mandating an increase in inflation rates to try and make people spend less money, with the hope being that this will reduce the CPI and in turn the inflation rate. This increasing interest rate will affect people who are currently looking to take out a loan, but also existing loans that have a variable interest rate. This is because the interest rate can change over time. Any existing loans with a fixed interest rate won't change though, because the interest rate stays the same throughout the whole payment period for the loan. Some mortgages have a 5-year period of which they're a fixed interest rate, but once this period is up, it will change over to variable. As I've been saying, these rising interest rates means that you would have to pay the bank more money per month. This means that the banks would be more reluctant to approve loans because they would have to make sure that you would be able to pay these higher amounts. So this ends up meaning that the bank may take longer to approve loans and less loans would be approved overall. What this would mean for people looking to buy their first home is that they would have to have more money saved up or would have to have a higher paying job for the bank to accept them. This makes it a lot harder for younger people to take out loans and reduces the amount of buyers in the property market. This reduction of demand within the property market will slow down the current astronomical property value rise, allowing for the housing market to become more stable and hopefully allow for younger people to have more of a chance when entering this market in the future. The overall slow of inflation will also affect the rate of which everyday items increase in price. This should make it more affordable for younger generations to be able to purchase these items in the future, allowing for them to save more and be able to enter this market even earlier in the future. Interest rates also affect any savings in a bank account. This is because the bank has an obligation to quote-unquote thank you for saving your money with them, and then allowing them to approve more loans. However, the increase in interest rates are adopted a bit slower in terms of savings. So this means that if loan interest rates rise, then it may take a few months to a year for the same change to be seen within savings accounts. Interest on your savings works in the way that banks pay you a percentage of the amount of money that you have in each bank account. And this rate loosely follows the interest rate on loans because banks use the money in people's savings accounts to then be able to loan people more money. The savings interest rate is always going to be a bit lower than the loan interest rate because the difference in these rates is how the bank makes profit. That's all for me today. Please hit the like button down below and subscribe for more content. Feel free to check out my website and other videos if you want to learn more about finance. See ya!